Matthew is on the Zoom to present our financial planning presentation for today. Our financial planning for Carrie and Cody, the assumption date is January 1st, 2025. And we have our student code number. Our today's topic is to present the cash flows and net worth summary, key financial ratios, home purchase readiness, insurance needs, and the three main recommendations. I will present half of it, and Matthew will proceed the next one until our three top recommendation. So if we I start from cash flow as of January 1st, 2025. Their net monthly income is around 10,064. Total monthly expense is $10,064. Net cash income is zero. No monthly surplus available for Cody and Carrie. And major expenses for them is rent, groceries, eating out, and car cost. And the net worth as of January 1st, 2025 is asset is around 13,112. Liability 36,000. Net worth is around 77,112. TFS plus RRSP total is around 62,300. So their important ratio liquidity, the ratio as we calculated is that the liquidity ratio is 0.46, that it shows low. So they have to think over it to have the home in the future. So asset to debt ratio is 3.14. That is a strong part, and they have to keep it up to increase this one. Debt payment ratio is 4.47. That is healthy. The concern part is to minimize payment on credit card, and that is 49 months payoff. So we have this part. The next one will proceed by Matthew. Thank you.
Thanks so much, Amino. So I'm going to just discuss off the top your home savings goal of 164,000, which would be 20% of the down payment. So currently your savings are mainly in the TFSA, 31,300. You'd be looking at a projected need to save $142,367. There is a shortfall there of $21,633. So we'd need to look at increasing your monthly savings to about $1,300 a month. So yeah, we need to discuss some options there, maybe budgeting as well in the future to reach that goal. So looking at mortgage affordability, the mortgage amount that you'd be looking at, $656,000, and with a monthly payment of $3,944, your gross debt service ratio and your total debt service ratio, 32.96% and 39.06% respectively. Certainly within limits. The challenge is when you look at the stress test. So if you're looking at higher interest rates and adding a stress test, increasing it by 2%, you do hit a total debt service ratio, which does put you into the high range. So we'd want to discuss options there and strategies there. So, looking at your life insurance needs right now, Carrie has 1.4 million and Cody has 1.25 million. I think the main need that we'd be looking at is primarily for disability insurance. Protecting the income, your income stream if one person is not able to work for a period of time. Certainly an emergency fund can cover some of that time period, but you'd want to look at something to cover a longer time period if you were looking at an event an accident that puts you in a position where you can't work. So finally, we'd like to discuss our recommendations. So off the top, we'd like to recommend that you do look at paying off your credit card debt as a priority. It does have the highest interest rate. If you did look at increasing your payments to about $2,000 a month, debt would be paid off in about 8 to 9 months. If you were able to increase it to that level versus what you're currently paying in minimum payments, you'd be looking at saving about $6,366. So a significant amount of savings there. Um, Secondly, generally you'd need to be looking at increasing your savings if you're wanting to reach that down payment goal. Your money is currently in a TFSA. You can certainly save for a down payment that way, but there are certain tax advantages to looking at a first home savings account, which is a new type of account where it allows you to contribute $8,000 annually with a lifetime maximum of 40,000, and it gives you the opportunity to take that money. If it's for a home, there's no repayment that's required compared to the RSP first time home buyers plan. It's going to have a repayment element, but also valuable. The government, as of April 1st, 2024, increased the limit to $60,000. So between those two amounts, you could save $100,000 in a more tax efficient way than the TFSA. And the main reason is because your contributions are tax deductible from your income, whereas the TFSA, that's not the case. So lastly, we'd certainly recommend you don't have an emergency fund per se. You could allocate your existing TFSA savings, some of that, to form part of your emergency fund. Certainly, people do use their TFSA as an emergency fund, but we'd actually recommend setting up a separate savings account and looking at a minimum of 3 months of expenses. And thanks so much. If you do have any questions for us, let us know, and we can certainly help you with that. And thanks for your attention today.
Thank you, Matthew.